Good evening, good evening, good evening, and welcome to another Life After Hours. That time of the month when we shine a spotlight into the deepest, darkest corners of personal finance. And of course, it is that time of year. So we are talking tax returns. So thank you for joining us on this warmish Sydney evening, and we shall I'll just give people a minute or so to get going. But as always, we acknowledge the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. So July 1, the beginning of a new tax year, has come and gone. We're now almost through the first month of the tax year, and much of the non-investment pre-fills will be in your MyGov account. Your employment information should have been in on the 14th, and if it's done, it will be showing up as tax ready in the portal. But we're getting ahead of ourselves, so let me pause with a bit of housekeeping. We do have a poll in the polls section, so if you could pop over there and tell me how you sent in your last year's tax return, and we'll see how the Life Sherpa audience or community compares to the population of taxpayers as a whole. Before we do get on, it's just worth looking at that word tax return. Many people think that the money they get back from the government is the return. Well, the return is in fact the form. So it dates back to the 13th century, where the average punter had to return their income to the king, because of course all money originated from the king. And so you had to tell the king's messenger what your income and expenses were for the year, what your farm produced, and that's why it's called a return. The money you get back, of course, is a refund. And I know many people look forward to getting a refund, sorry. And but of course, a refund is really just the government giving you back money that you've lent to them for the year, and they don't give you interest on it. So a big refund is not necessarily a good thing. Feels good at the time, but it's actually money that you loan to the government along the way. Most of our PAYG system is designed to ensure that the vast bulk of taxpayers end up either owing or receiving up to $1,000. So if your refund is larger than that, then you've been lending the government money. So with that said, I'm now going to pop over to Canva and share my screen. So if you do have any questions, just pop them in the chat, and I will get to them as we go, or at least catch up at the end. So these events are about you. So let us have your questions. That's why we're here. And that's why we have this thing rather than a video. So let me just turn my screen share on and pop across to Canva. And so doing your annual tax return and keeping the records necessary to do so is part of the housekeeping summit. So as most of you will know, we look at most financial planning and personal finance items across 9 areas or summits. We have the 3 foundation summits: spending, that is, keep a budget, spend less than you earn; emergency stash, build an emergency stash, pay off your debts. They're the 3 foundation summits. We then have 3 protective summits: prepare for the unexpected, that's insurance, get your super sorted, and get your housekeeping in order. And then we move on to the three, I guess, more exciting growth summits, which is buy and pay off your home or property, investing, and of course, retire well. Tonight, we're looking at housekeeping, which includes things like your will, power of attorney, estate planning, and nominations for your super fund, all those sort of paperworky things. And keeping the right records is key here. So that's the housekeeping piece. That's where we're tonight. And if you'd like a little bit more detail on all that, you can scan the QR code on your screen, and our Freedom Factor will help pinpoint where you are on the path to financial independence and get your personalised next steps. Let's have a look at the key changes for the year. So the working from home fixed rate of 70 cents an hour hasn't changed, so that's still the same. The 88 cents a kilometre for work mileage in your car up to $5,000 again is unchanged. Help repayments have now on the marginal system, so no repayments to $67,000 and 15 cents in the dollar from there to $125,000. That certainly avoids many of the big steps under the old system, and more and more data is being pre-filled. They're probably the big changes. And of course, the ATO's data matching gets better every week or every month. They get more and more data, so they are able to assess the reasonableness of your return, and things that stick out from the norm will get queries. So don't be surprised if you get a please explain. Please explain is a long way short of an audit, though, so don't get too stressed. If you've got the paperwork and they ask you why have you claimed so much work deductions, then you should simply be able to tell them. In most cases, that will satisfy. We talked about the budget a few months ago, and of course, we were Life Sherpa and the Money crew were down in Canberra for the budget. You've probably seen some of that on YouTube or LinkedIn or Facebook, wherever you hang out online. And a couple of the big announcements. So the $1,000 standard deduction. So that is everyone with work income from employment gets a standard $1,000 deduction, but that comes from the tax year we're in now, not the return that you're about to do. And similarly, the Working Australian Tax Offset, the $250 offset, again, doesn't come in until next year, so the 27-28 year. So plenty of anticipation for those. And in the year we're doing the return for, the 16% bottom tax rate still applies. That drops to 15% in 26-27 and 14% in 27-28. So what I want to run through tonight really is getting started, how to do this using MyGov and what you need to have in place to do that. Looking at what the MyGov screens look like and how to set up the return to make sure you get asked only the questions you need to be asked. Looking at the income that needs to be returned. Special bit of stuff around dividends and franking and trust distributions and ARMIT adjustments. A little bit about rental deductions, and then just getting back and looking at general deductions and the overall philosophy. So the MyGov system is getting so much better, and the pre-fill is getting so much better that more and more people are adopting it as distinct to paying an agent. And really, if you don't have self-employment income and you don't have property income, most people should be able to do their own return. But anyway, let's press on. So the key thing before we get started is to make sure you have the right records. Make sure that everything you need to do is pre-filled. So right now, if you only have employment income, interest, and probably property deductions, maybe a bit of income protection, some health fund, you probably are ready to go now. If you've got some investments, so you hold some shares, some ETFs or managed funds, you're going to have to wait a while until you get your statement from the insurer. Not from the insurer, from the fund manager. So again, before you log in, so get your tax time kit together. So income statements, bank statements, dividend and annual statements from your shares, ETFs and managed funds, rental property records. You probably have a statement from your managing agent or estate agent. You'll of course been keeping your receipts and time records as you've gone through the year. If not, now's the time to tidy that up. And then if you've sold any assets, including crypto or shares, you need to know what your gain might be. So the pre-fill, extraordinarily helpful, saves time, but it's still up to you to check it. Mistakes do happen. With single touch payroll, where employers are reporting to the tax office on the day they pay the payroll, those sort of errors are much rarer than they used to be. But certainly when it comes to managed funds and interest, it is quite possible for there to be errors. So up to you to check. So assuming you're going to do this in MyGov, obviously you need to sign up to MyGov and go to the linked ATO service. If you haven't already done that, it's a bit of a palaver setting it up on the first day, but definitely worth it in the long term. So the first thing you've got to do when you get into the MyGov tax return piece is to tell it a little about it yourself, so that it knows which questions to ask you. So when you are personalising returns, it's going to want to know about your tax residency. If you're not an Australian tax resident, then the rates are going to be different. They need to know whether you've got a spouse or not, which really only affects the calculation of Medicare exemptions, Medicare levy, surcharge obligations, family tax benefit, childcare subsidy. They're the main ones, but Australia doesn't have the concept of filing separately or filing as a couple. We each have our own individual taxes, but there are a couple of crossovers which do affect us as couples. They obviously want to know what type of incomes you've received over the year, and that will trigger some of the deductions. So if you don't tick that I had interest income, it's not going to ask you the questions about interest expense deductions. So care needs to be taken here. Similarly, you want to know whether you had investment or property income, and that will then open up those deductions. If you've got business or side hustle income, again, that will help. And then which offsets or deductions you're going to claim. So a few ticks now will save you plenty of hunting later. So be careful answering those questions because it affects which screens you're going to see. So here's an example. So here's saying, well, what income did you receive? So I've ticked, receive salary, wages, or other income statements. So in this case, salaries and wages. You might have some Australian government payments. You might have got a redundancy payment. You might have got some first-time super saver withdrawals. So tick the right boxes here. If you're receiving a pension, you want to tick the Australian superannuation box. If you've got interest or other things, just tick the right box and it will show you the right screens to do that. And one thing that tax office is getting really strong on is income from the sharing economy. So if you've got your car on one of those sharing websites, you've got your caravan on Camplify, you've got your Airbnb, your house, the tax office will know. And so don't try and hide it. Similarly, if you get paid in cash, you obviously have to declare it. And, if the person paying you the money has claimed it as a deduction, the tax office may very well know about it. So it's getting really hot on these things. And it gets returns from Airbnb, Uber, Airtasker. So all of these websites and marketplaces are now reporting to the ATO. So they will know. So when it comes to income, obviously, you got to check every dollar you earned and check the pre-fill. Almost anything you earned will be taxable. Winnings on the TAB are probably, generally, gambling winnings generally are exempt, but most other income will be taxable in some form. So start with your pre-filled income, but check it. Don't simply trust it. It's almost certainly correct when it comes to employment income, but other amounts I wouldn't be betting on. But it's getting a lot better. And then we move on to the declare the income. Now, they ask you for your occupation for employment income. And this is important because this will, whilst it doesn't affect the amount of tax you pay, it will affect their data matching. So if you write down that you're based on your occupation, they're going to say, here's what a pharmacist typically claims, here's what a registered nurse typically claims, here's what a tradie typically claims. And that's used in their assessment as to how reasonable your claims are and whether you're likely to get a please explain letter subsequently. Generally, they'll pay the refund and ask questions later, unless it's outrageous, in which case they might get thrown out for additional human scrutiny. But generally, 90+% of these will go through untouched by human hands, and your refund will just turn up, and they may come back and ask questions. So getting your occupation right will affect the expected type of claims you're likely to be made. It can be useful to Google your occupation and ATO deductions, and it will give you a list of the sort of deductions that most people in that occupation claim. Might be too late for this year if you don't have the receipts, but definitely worth checking out. Here it's asking me to add my managed fund and trust distributions and any deductions that relate to it. So the working from home, so here we got deductions against, so this is the income side, so interest, dividends, managed fund distributions, rental income, capital gains, and then it will eventually total it at the end and give you the opportunity to add your deductions. It's all pretty straightforward. You may be eligible for some offsets, low income tax offset, seniors tax offset, medical expense offset. Most of them are worked out automatically, but definitely worth ticking it. Now, the income tests are largely used for things like Medicare levy surcharge, FTB eligibility, spouse co-contribution, etc. So it's going to ask you, whether you have any dependent children and whether you had a spouse. Now, you're not expected to know to the cent what your spouse entered. The closer you can get it, the more reliable your pre-calculation is going to be, but they will match that in the background. So in this case, here we're looking at the Medicare and private health insurance, which is one of those things that affects on your household income. But for most practical purposes, if you're earning $100,000 or more, you'll probably find that having private health insurance, even if you never claim on it, will cost you less than paying the Medicare levy surcharge. And then they're just going to ask you for some statistical reasons how you completed your return. And that reminds me, so tell us in the poll which way we did yours. They're also going to ask you whether this is your last return. If you've retired and you got no income other than the age pension, then you can probably tick no, I won't have to do another one, or you're moving overseas permanently. But for the most part, you're going to be ticking yes to this question that I will do another one. And then ultimately, it's going to give you an estimate at the end here. So, again, it's relatively straightforward unless you've got complex stuff. So if you're self-employed, you've got a investment property, maybe for the first time, and you need to get your depreciation and maintenance schedules done. That can often be worth paying a couple of $100 for an agent. But for basic PAYG plus interest plus a little bit of income protection insurance, maybe it's not that hard these days. But the income that often gets missed out, side hustle and freelance income. So if you're flogging a few things on Facebook Marketplace, if you're just selling the kids clothes they've grown out with, or the golf clubs you don't get to play anymore, that's not taxable income. But if you're making a business of buying and reselling stuff, you will eventually be in this category. So be very careful about that. Sharing economy of income we talked about earlier, these guys are all reporting to the ATO now. So they will know that you've had your caravan on Camplify. Cash payments we talked about. It's easy to forget with the odd bank account that you might have a little bit here and there. The ATL will notice it missing, no matter how small it is. Most banks are pretty good on the pre-fill as long as you've given them your tax file number. If you haven't given the bank your tax file number, you may actually benefit from including it because they might owe you some tax. Foreign income is one that a lot of people forget about. So if you've got quite a few people, I keep a bank account in the UK for when I'm traveling over there. And so I've got to remember to include the interest on that account. That won't get pre-filled, even though your Australian taxes will. I've moved to a Revolut multi-currency account now, so I'll be interested to see whether Revolut in Australia reports the interest on non-Australian dollar accounts. So I want to see what happens with that one. And then, of course, the one a lot of people forget about is crypto. There's lots of crypto transactions that create a tax obligation, even if you may never have seen some actual fiat currency. And, remember, the ATO has a long memory and it's got access to a huge amount of data now. This is a self-assessment system. So the ATO is relying on you using your best endeavors to pay the right amount of tax. And it will identify unjustifiable claims for the most part. Maybe not today or tomorrow, but they do have 2 years to go back. Dividends is the tricky one. So if I just go back up. So under the dividends section, Here's how you're going to report dividends and franking credits on the shares you own. So listed investment companies, normal shares go here. And that includes amounts that you've reinvested. So if you've ticked the DRP box, the dividend reinvestment plan box, and you never see the cash, you still have to pay tax on it, and you still get the franking credits. And so they will probably be reported here. And so while shares and ETFs might look very similarly, they might trade together, but they don't lodge together. So shares in an Australian company go under dividends. Units in an Australian ETF or managed fund go under managed funds and trust distributions. And non-Australian ETFs will often go under the foreign income tab. You'll recognize the difference there because you won't get an AMIT statement for your overseas ETF. So VTS is a good example of VEU potentially. So some of the non-domiciled stuff, or if you're buying ETFs listed overseas. So just be careful. Many of the AMIT statements these days are actually labeled with the box number that you're supposed to put it in. So here's the dividends box. A lot of this stuff is not supposed to, it'll either be pre-filled, and so when CBA declares a dividend, they will report it to the ATO, and it should turn up here as long as you've given Computershare your tax file number. And but you need to check it to your statement, especially if you've been DRPing. Trust distributions, or mostly ETFs for most people, starts to get fairly complicated. There could be 30 line items on your AMIT statement, and you need to check that it's properly filled. And many of these won't get issued till August, September. So you might need to be patient on these ones. So with a distribution that you're going to get from an ETF, it's likely to include Australian income. It's likely to have some franking credits to the extent that it's got an Australian company in there. It's quite likely to have some capital gains from transactions within the fund. It may very well have some foreign income, some of which can arise from Australian trust companies with overseas operations still get some foreign tax credits, and of course any offsets or credits. So if you've got an LIC, you're likely to get an LIC offset designed to fix up the fact that an LIC pays tax on its income and then makes it franked distribution. But some of that income includes capital gains, which if an ETF had incurred them would have passed on the capital gains discount to you, or indexation under the new rules, whereas an LIC pays company tax on everything. So it comes with an offset to a tax offset to offset that difference, to put them on a level playing field. Now, interestingly, that wasn't removed in the budget, and of course the LIC is not going to get indexation. So, but the way the offset's been calculated hasn't been changed in the budget. So watch this space on that one. Here's where you transfer all the stuff from your AMIT, or it will be pre-filled. So you'll recognize these numbers like 13U, non-primary production income, 13C, total frank distribution. These will usually be labeled on your wrap account statement or your AMIT statement from an individual fund. It makes it quite easy to cross-check here. But if you're holding 10 ETFs, this can be a bit time consuming and administration intensive. And that's where a tool like a wrap account or a software tool like a ShareSite comes in. So that's the shares and dividends financial instrument investments. About 1 in 5 Australian taxpayers have rental income. And so that's probably the next most common source of income and deductions that Life Sherpa members have. And there's a few traps for young players here, and sort of making sure that you've got a depreciation schedule and making sure that you've got all of your expenses accounted for. This is often a good argument for having your agent pay all the bills so that your agent statement generates the true one. So I usually get my agent to pay the rates, the water, and the maintenance so that you get a net return from your agent. Some people prefer to do that themselves. I'm paying 7% of my rent. I want you to do this work for me. And then I get a single statement that tells me everything. But each to their own. So starting with the property itself, which is obviously the source of the income. So what matters is who owns it and when was it genuinely available for rent, because that determines who returns the income and who claims what expenses and what expenses are available for deduction. So ownership percentage, obviously the big one. And this is something that you should think about when you're starting your investment journey. Are you buying this as an individual? Are you buying it jointly as a couple? Are you buying it in a trust? And the natural instinct for most couples is to buy jointly. If you're in the negative gearing regime, then you might want the higher tax rate payer to own the property. If you're positively geared, you probably want the lower rate taxpayer to own the property. Now, there is interworking with the loans. If you're using equity in your home for the deposit and the mortgage is in joint names, you need to think about how that flows through to the deduction. And you might need to have effectively a loan agreement between you. So a bit of thinking, that's a job for your accountant. So, good reason why at least the first year you might want to use an agent for this piece. When your property is available for rent, absolutely critical. So, generally deductions before it's available for rent aren't going to be deductible. So if you buy a new property and you spend some money on changing the locks and painting a little bit to make it available for rent, they will usually not be deductible. They'll end up going into your cost base. The income you earn, so rent is the obvious one. You may get reimbursed for water expenses. You may get paid out insurance payments. So if you claim on your landlord's insurance, some of that may very well be taxable income. You then need to factor in private or family use. So if you've got a ski lodge in Thredbo that you rent out, but you spend 2 of the best weeks in the September school holidays doing it, then you need to apportion your expenses. And the tax office has had it's issued a new ruling on this, which you should read. And this is one of their areas of focus for this year. So again, you enter into the property details. Much of this stuff doesn't necessarily get transmitted, allegedly, to the ATO, but I would always be very careful what I write in on these. So we'll come back and talk about it when we get to work from home, though. So once you get past the first year, then you'll probably find that it will be 52 weeks most years. So pretty easy to fill in. And when it comes to expenses for your rental property, you've got some expenses that are claimed immediately. So agents' fees, rates, interest, routine repairs, insurance, they're all operating expenses claimed in the year they incur. And you may find benefit in prepaying some of that and getting that timing right. You can prepay up to 13 months of most expenses. So that may become a big deal for people who whose income is going to change in the next year. So if you've jointly own a property and one of you is going on paternity, maternity leave, parental leave, then might be worth prepaying expenses before you've got a year of lower income. There are other things that you claim over time. So capital works, assets that you depreciate, lender's mortgage insurance, that sort of thing. And it's the distinction between what's a repair and what's capital works can be a little arcane. So getting that right is important. So fixing the hot water service is a repair. Replacing it with a heat pump is capital works. So think about what you're doing when you pay the bill. There are things that are not deductible, and usually these go into your cost base for capital gains purposes when you eventually sell. So obviously the price you paid for the property, principal repayments on your home loan, anything related to private use. Stamp duty on the purchase, except in the ACT. If you buy a property in the ACT, technically what you're doing is entering into a very long-term lease. So stamp duty in the ACT is deductible in the year you pay it, but not in any other state. Depreciation can be a big deal, especially if the property is reasonably new or you've done the works. And so getting a depreciation schedule done will be worth its weight in gold, especially if you're going to hold the property for a long time. You should be able to get a good depreciation schedule for under $1,000 and worth doing, especially for a newish property. And here's where you put in your the typical expenses, your advertising, body corporate fees, borrowing expenses, cleaning, council rates, gardening, insurance, all those sort of things that you'd expect to pay. Which brings us now on to general deductions. And there are three key things you need to be aware of when you're claiming. So you should ask yourself these three questions. Did I pay it for myself without reimbursement? So if you spend some money and your employer reimburses you, not deductible. If you spend some money and the insurance company reimburses you, not deductible. Or if it is, the insurance payout will be taxable. Does it relate to earning my income? Work, professional development is a good example. So if you're doing training that improves your ability in your current role, tax deductible, unless your employer reimburses you. Your professional institute membership, deductible, unless your employer reimburses it. Doesn't necessarily have to be that it's mandatory for your role, but if it's part and parcel of, so you might be working as a CFO in a company, you don't necessarily need to be a chartered accountant, but paying your chartered accounting membership fees and your annual CPD points, absolutely tax deductible. Where it's not deductible, if it relates to you getting another job. So if you're a financial advisor and you want to train to be a yoga teacher, well, your yoga training is not deductible. And then thirdly, do you have the records showing that? So there'll be a receipt, usually if it's for expenditure, if it's for working from home or travel or your car mileage, you're going to need a diary note or some sort of schedule to justify that. So working from home is the big one. So most people will work from home for at least some part of the year post-COVID. And so the simplest and easiest way to do that is the 70 cents per hour. Now, I mentioned about some of those fields in the MyGov not being transmitted to the ATO. This is where I suggest that you don't rely on that. So I have seen people type in 4 days times 48 weeks times 77.6 hours equals X. You can't just make it up like that. You've got to have, I actually worked 7.6 hours on the 4th of June. I worked 7.4 hours on the 10th of June, etc. So it's got to be ideally contemporaneously, but you need a diary that shows which hours you did work. So don't just go, oh, I work 4 days a week at home, therefore 4 by 48 by 7.6. You need the actual hours. Similarly for car travel, you need a diary that says, I drove 4 kilometers from Wollongong to Thirroul, or whatever the distance is, on the 4th of June, and here's why I did it. Driving to and from work is not deductible. Driving between work sites is, and of course it's not deductible if your employer reimburses you. And both of those, there is so much electronic traffic that this is not somewhere to start fudging the data. Yeah, your phone knows where you are. Your toll tag in your car knows where you are and when you went there. So these are things that are readily verifiable or questionable by somebody else. So make sure you do keep the data. 20 years ago or 30 years ago, you might have been able to fudge a diary and it was very hard to verify. But today there is so much electronic tagging of where we go and what we do that this is not to be fudged. Work equipment, so some of that's deductible straight away. So if you've got a mobile phone, laptop, they're all deductible in the year you buy them. Tools, etc., will get depreciated over a time. Self-education we talked about. Donations. Now, donations, an interesting one. You generally need it to be paid to a deductible gift recipient. So be careful about GoFundMe. Very little of that is eligible. And of course, you get to deduct the cost of your tax agent and the cost of your share site subscription, for example. And again, here's the screen where you put that in. It's all pretty straightforward. And now, before you hit the submit button, double and triple check that you've got this right. Have you got all the income included? Does all the pre-filled data match the paperwork that you've got? Have you put the investment income in the right place? Have you apportioned any shared or private expenses? Do you have the support for every deduction? And does the estimate look plausible? Now, it is not unreasonable that you might have a estimate that looks implausible, but as long as you've got the paperwork to defend it, that's fine. The tax office is not making judgments on how much personal development you did during the year. The question is, is it relevant? And did you do it? And have you paid for it? And do you have the receipt? They don't make moral judgments. So, as with a lot of things, it's certainly worth knowing where DIY stops being simple and when you should move to an agent. So if you're operating a business, you might be able to do your BASs if you use a tool like Xero or QuickBooks or MyOb. You can probably do your BAS on your own, but I'd be getting an agent to deal with the annual return. If you've got multiple investment properties, again, great indicator that you should use an agent. Larger complex capital gains, especially if you're selling a business, that should be planned well in advance, and definitely a source for a reason to have a professional. Foreign income or overseas assets, if you've got an overseas family trust or you've got assets overseas, starts getting complicated. If you've got a trust, estate, or anything unusual, use an agent. And if you don't have any records, then be very, very mindful. One of the questions we often get asked is, how do I pick an agent? If you're, so let me back up a bit and go. It's very difficult to earn a reasonable living as an agent doing personal tax returns unless you've got scale. So there's a reason why H&R Block is so big. So if you're not running a business or got complex stuff, use a agent that does lots of it. There is absolutely no point going to a big end of town accounting firm who will just shunt your work off to a junior, often offshore. So look for someone who does lots of them, unless you're running a business, in which case they might do your personal return as a bit of a favor. But so for simpler returns, it's pretty hard to go past H&R Block, but definitely make sure that you are looking at someone who does lots of personal tax returns. And you're not going to find them on Pitt Street generally. And so that's really the 101 on, or the 411, depending on where you're coming from, on how to do your tax return.